Well, thank you all for joining our Q1 investor call. On the call, we have our lead portfolio managers, Craig Banderson, Tony Shrian, Rena Ort, together with myself, Harry Wilson, joint CEO of the group. Hope you all received the email we sent about an hour ago, which included both an agenda for the call and the brief presentation, which we're going to refer to on the call. As per the agenda, I'm going to give a brief update on the business, and I hand over to Craig, who's going to lead the conference call today, giving you an update on the performance for Q1 and the outlook for the year. In terms of the business, the merger, which was completed over a year and a half ago, has now all been finalized and has gone very well. We're now working on improving our communication with you, our investors, and also improving our education to our investors. And part of that has been, firstly, I hope you'll notice an improvement to the detail and depth of this call. We're also now encouraging our investors to come on trips with us across Africa. We had a number of successful trips last year to Egypt, Kenya, Zambia, Zimbabwe, and South Africa, which was very positively received by the investors. When you get out there and actually meet them, they were hugely impressed by the quality of the management teams of the companies that we invest with. The Fleming Wilson families, together with the other shareholders of the Imara Group, have been investing in Africa for many decades. I think what I'd like to stress to you is we're particularly excited about the opportunities right now for two key reasons. One, African markets continue to be highly inefficient, much more so than developed world, which really favors the team's active management style. And also right now, you have an opportunity for stocks that are trading at near all-time lows, so similar levels as after the global financial crisis, despite a decade of fundamental improvement in both the companies and countries in which we allocate to. So we thank you for this opportunity today to discuss this with you. I'll now hand it over to Craig to give more detail about the performance and the outlook. Thanks, Craig.
Thank you, Harry. I think we'll start off with the performance. So if you move along to slide 3. And what we have here is our Imara Africa Fund Class A shares. As we've communicated to investors, it's one strategy, which is an Africa listed equity strategy. It's one strategy and several products. And what we're holding out here is Class A. Now, for the quarter, the fund was up 5.8%. We have included performance numbers for the local indices and the two large Pan-Africa indices, MSCI Africa and S&P Africa. You can see that there was widely dispersed performance across Africa. Africa is not just one place, but a patchwork of different countries pushing and pulling in different directions. And part of what makes our job so exciting is finding these uncorrelated return streams in the different markets and shaping the portfolio accordingly. You can see from the country allocation, our large allocations are currently to Morocco, Egypt, Nigeria, and Kenya. We call this MENC. This is about 85% of the market cap and liquidity in Africa ex-SA, trading about roughly $180 million a day. In terms of sector allocation, we have a large allocation to financials, which is 37%. But the ultimate theme we're trying to get access to is a domestic consumer theme. So these financials have strong deposit franchises with a good low cost of funds and fee income generation potential. The other big sectors that we invest in are in telcos, fintech, and consumer staples. These three together represent 44% of the portfolio. 81% of the portfolio is therefore in financial services, fintech, telcos, consumer staples. Now, moving on to the next slide. That's an infographic on some of the key macro indicators we look at. We're a bottom-up fund. The real focus is on the underlying opportunities, but a read across these markets, you can see that there's positive macro tailwinds in all of our markets. What you saw across Africa was that there was kind of a faster tightening phase. When the anticipation was Fed normalization and the hiking of rates across our markets, our large markets, especially Egypt and Nigeria, you saw a hiking of rates in anticipation of this. Touching on the individual markets, we'll start off with Egypt. Overall, there's a positive reinforcement of several key macro items. Tourism was up 16% last year, and this is a huge sector. It's 9.5% of employment and 12% of GDP. The gas story is extremely strong this year. Production is expected of 8 billion cubic feet. Demand is closer to 6.5, 7 billion cubic feet. That leaves exports of between 1 billion and 1.5 billion cubic feet. Remittances were also up strongly, up 5.7% to 23 billion, and the subsidy reform or fiscal reform program continues, and it's extremely positive for the fiscal deficit, which we expect to drop to 7.2%. All these positive indicators lead us to really find the macro and the micro in Egypt extremely strong. We expect the final allocation of the 2 billion tranche from the IMF to be dispersed in July, which will boost reserves further. There will be upside risks, though, to inflation from subsidy removal, but core inflation remains moderate. In February, the CBE had a surprise cut of rates by 100 bips. This was a welcome positive surprise and reflects confidence in the macro, given the impending subsidy removal. The pace of real wage recovery has been faster than expected, and local companies are showing positive volume growth, in some cases getting close to or surpassing the 2016 pre-devaluation levels. We met with several Egyptian corporates at an Egypt conference, and we're encouraged by not just the volume growth prospects, but the ability of them to pass on price to the consumer. Opportunities in Egypt are numerous and diverse, and we're positioned in strong deposit franchise banks, healthcare, and consumer-facing companies. In services, we're positioned for a return in CapEx spending from blue-chip corporates as rates drop, as well as retail banking in the middle. In healthcare, we like pharma and clinical pathology businesses where the population is under-tested for chronic illnesses and the government is looking to expand healthcare insurance. Both these themes of pharma and clinical pathology are defensive, but have a long runway for growth, and we've been positioning the portfolio to exploit these themes. Another encouraging bit of news was the upgrade from Fitch. It upgraded Egypt's issuer default rating to B+ from B with a stable outlook. Nigeria, overall, not much has changed. The market is in a holding pattern with some selling pressure. There was a week-long delay in the February elections, and we were very excited with the voter registration numbers going up to about 84 million voters from 68 million voters in 2015. However, the turnout was disappointing at 35.6%. A major theme that we communicate to investors is the increase in student voter registration and our view that the politics of the stomach will dominate over the politics of liberation, and you'll see an end of kind of the poor or the misalignment of economic policies and job creation. The actual numbers that turned out to vote disappointed us. Nonetheless, we remain positive that voter registration will continue to go up, and we shall see leadership that can create employment and opportunities for this youthful population. Nigeria is in an early recovery phase, and it was no surprise that the central bank lowered rates by 50 bips, reducing the MPR from 14 to 13.5%. However, this is an indicative rate. There's a poor transmission mechanism. A genuine move would have been to reduce the cash reserve ratio. This would have indicated to us a more expansionary monetary policy, and the current cash reserve ratio, remains at 22.5%. Still an extremely high rate. Despite a positive upswing in PMI, the quarterly earnings on a corporate level have been poor. Nonetheless, we're more focused on the long-term themes, and we expect to see a slow improvement in disposable incomes as the year progresses. The recent approval of the minimum wage increase should have a positive impact on aggregate demand. Over-regulation and FX policy remain two large sources of market inefficiency, but we believe that valuations at current levels present an attractive entry point. Nigeria's current growth is lower than both Egypt and Kenya at 2.4% target. Global growth is guided at between 2.9 to 3%. The lowest growth number we have in those four countries is Nigeria. Morocco is sitting at 3%. Egypt and Kenya are sitting at about 6%. So in that context, Nigeria still is on a path to normalization and the early recovery phase. A big issue there is the need for clear policy direction from leadership, and we should start seeing that in the second half of 2019. In Kenya, the year started off on a negative note with the terrorist attack at a hotel and office complex in the capital by Al-Shabaab militants. Whilst the loss of life is always sad, we were encouraged by the responsiveness of authorities and the resilience of the Kenyan people and the economy. Kenya's stated foreign policy is a strong alliance to the US, and therefore there will be sporadic attacks from outside of Kenya with no long-term lasting impact on FDI or tourism. The IMF sees the economy growing at 6%, and the risk to the downside come from poor rainfall in some parts of Kenya. But on the whole, the economy is positioned to maintain its high growth rate with growth targets of, GDP growth targets of between 5 to 6%. Remittances were up last year 39% due to the amnesty program. And although private sector credit remains muted at 3 to 4%, we should see growth maintained at current levels. A bit of positive news: the High Court declared that the interest rate cap was unconstitutional. The basis for the ruling was on issues related to ambiguity of the clauses. The court ruled that MPs have 12 months to amend the irregular clauses before the declaration of the ruling is given effect. We asked the banks on the issue. They aren't commenting on the judgment, but generally they say they'll keep their focus on running the businesses, and it's a question of when and not if rate cap repeal happens. 3 to 4% credit growth is suboptimal given the opportunities and growth prospects of Kenya. We continue, however, to see exciting growth opportunities and innovation in mobile payments, and the high ROEs, well in excess of the cost of capital, present an attractive opportunity. Our case study for the quarter is Equity Bank, and we touch on why we like this theme so much. In Morocco, the macro remains extremely favorable, showing strong growth as well as stability. As I mentioned earlier, the Moroccan growth number is closer to the global growth GDP of 2.9 to 3%, but inflation is also lower with guidance of 1 to 1.5%. Morocco has a hothouse effect and low rates, so it's extremely difficult to find value. It is extremely difficult to find value and growth, and given the themes we like, we have been building positions in both the payment space and formalized retail, selectively buying at successively lower pricing. We feel that long-term, the compounding of growth in these two sectors should make valuations attractive. Formalized retail is only 15% of the market, and despite the presence of hard discounters, we feel that the ability to give convenience, an affordable price point, and quality are differentiating factors in the retail space. Now I'll move on to a case study, but before I do that, I'd just like to do a quick refresher on our process. Most of you have heard this, so I'll just touch on QVG, which is our database. Now, when you look at slide 5, I've listed our beliefs, which have come from 15 years of investing in the continent. We believe that businesses geared to the trends in Africa should outperform. And these trends are a shift from informal markets to formal markets, or traditional methods to modern methods, and geared towards the youthful population and geared towards urbanization. These companies that can service this fortune at the bottom of the pyramid with convenience, an affordable price point, and quality will grow faster than the sectors they're in and faster than the economies they're in. A quality overlay is essential to mitigate a lot of the risks of investing in the continent, and that deep and rigorous research is essential in identifying the best opportunities. Building a high conviction, concentrated portfolio is the best way to capture this opportunity. Very quickly, QVG is driven by deep company knowledge we've built over the last 15 years. What it is a database that allows us to assess the quality criteria of a business. What we're looking for is corporate champions, companies that are masters of circumstance as opposed to victims of circumstance. Africa is a difficult place to operate, but some companies seem to consistently do well despite the environment. So what we did when we started out is we started compiling the positive attributes from our winning positions and stripping out the negative attributes from our losing positions. We built a database that allowed us to score the companies based on a Likert scale, measuring companies on various quantitative and qualitative attributes. And this gave us an overall systematic approach to picking these corporate champions. Once we've assessed this quality assets criteria, we then move on to valuation. We do two valuation methods. We're looking to pay a reasonable price for a company. The first method is a discounted cash flow, where we're looking to buy a company at a lower price than its intrinsic value, discounting cash flows of that business. We also look at the historic range of multiples over time, looking to buy a company that's at the low end of the range. So the combination of a price that's below intrinsic value and the company that's at the low end of the range gives us a margin of safety. Lastly, we look at growth, book value growth for banks, and operating income growth for industrials. We believe that growth drives price. A growing company justifies a faster re-rating of the price multiple. Now I'll move on to the case study on slide 7. Most of you already know about Equity Bank, but just as a bit of background, we've been invested in Equity Bank since we started the business. We know James Mwangi extremely well. We met him in the mid-2000s, and he's now CEO of the bank. His focus has always been banking the unbanked and providing a quality service to a community that was underserved and underpenetrated. A story that has received a lot of coverage is how James's mother used to walk over 20 miles to get to the nearest bank. And when she would get there, the building was intimidating, the tellers weren't friendly, the minimum deposit was more than a year's wages, and the service offering didn't meet her needs. More importantly, the bank didn't understand her needs. If you'll allow me, just go across to slide 8, you can see how Equity Bank has done over the years. The first phase of Equity Bank's deposit mobilization strategy was to provide low-cost branches and ATMs. The branches and tellers spoke the local language and were unintimidating and gave a service that was better than some of the other banks. Phase 2 was agency banking. This was the eureka moment that used third-party infrastructure. Management figured out that there's a wider distribution of kiosks and mom-and-pop stores that's wider than any bank network. By training up store owners to do basic KYC and offering a service to accept and dispense cash, they instantly had a wider network. Together with Safaricom, this led to significant growth in this agency banking model. Phase 3 of innovation, which is where we are now, is using a SIM overlay technology to offer customers the ability to transact using their mobile phones. Mobile penetration is even higher than bank penetration, so everyone can transact over their phones. You can see with the chart in front of you that mobile banking dwarfs the traditional ATM and branches channels. Using their phones, customers can make payments and do withdrawals and deposits at the agents. They can do cash in, cash out, and transfer money. Banks make money when money moves and when money sits. This is what banking the unbanked looked like. This is what an innovative, affordable product can do, and it has powerful economic implications, not just for the bank, but for the consumer as well. Equity Bank ends up capturing not just the deposit, but it does so in a cheaper manner than traditional channels, and this comes with high levels of cost efficiency. This is where companies really get exciting for us, and we see the same sequence play out in our winning positions. By addressing the needs of an underserved segment, there's a logical sequence of events that builds momentum. If you do A, you can't help but do B, If you do B, you can't help but do C. In this case, in Equity Bank's case, by banking the unbanked, you gather low cost deposits. With the low cost of funds, you can't help but offer attractive pricing for your loans. If you offer attractive pricing for your loans, you can't help but gain more market share. If you gain more market share, you can't help but have more revenue per fixed cost, which means higher margins, which leads to a higher ROE and inevitably gives you the funds to reinvest in innovation and further growth, cementing your competitive advantage even further. To illustrate QVG, I'll go back to slide 7. We've depicted this using graphical form. On the left-hand side, you see a Likert scale, which is numbered from 0 to 18 here, but the range goes from 0 to 20. A score between 10 to 13 is an average score. A score below 10 is a poor score, and a score above 13 is what we consider a positive score, a quality score. You can see that red line, if you follow it all the way from the left to the right, consistently stays above 13. So Equity Bank is a quality company, not just at a snapshot in time, but over time. This is what we're looking for when we say we're looking for a corporate champion. It's a company that can satisfy our quality asset criteria over a long time horizon. Then we move on to valuation, which we can see on the right-hand side in percentages. It's measured by the blue line. If the number is negative on the right-hand side, it means that the stock is trading at a premium to its historic range. If it's a positive number, it's trading at a discount. What typically happens, if you look at the left, is that when a company is a quality company, it trades at a premium. What's exciting about Equity Bank right now is that it's showing 38% upside and it's trading at a discount, but it's maintained its quality assets criteria. The last thing we then look at is the light blue line, which is growth. Have they been growing book value over time? You can see that light blue line is consistently above 0, showing a compounding of book value growth. Where we get really excited is when those 3 lines kind of converge in the top right-hand quadrant on that chart in front of you. That's where we would have a maximum allocation to a position, which is what we have with Equity Bank across our various products. Where are we now in terms of the cycle? If you move on to slide 9, we believe that valuations are close to their historic lows. If you look at PE ranges, we're at or near the bottom, which was, the GFC bottoms of 2008. We believe that fundamental risk has reduced. We've seen several big men go out of power. We've seen this youthful population become more vocal, shining a torchlight on several issues and looking for economic prosperity. And we believe this will be a big driver in more capital-friendly or business-friendly policymaking. We've seen the Arab Spring and the various cycles since the GFC, and the companies have actually grown in real terms. So when you measure these companies on enterprise value per hectoliter of beer, or enterprise value per base station, or based on the number of branches they have, or the number EV per store, you start seeing that these companies are trading at cheaper levels than they used to trade, but they're bigger companies and fundamentally more robust companies as they've survived various cycles. What do the numbers look like? If you look at slide 10, you can see how Africa compares to emerging markets and world markets, of which 60% are developed markets. We have a lower PE at 9.1, a higher div yield 5.2, and a higher dollar ROE of 20.4. Company fundamentals have improved, but Africa is still trading at a discount to emerging markets. This is exciting for us because we feel that we're positioned well for a return of risk appetite to emerging markets and frontier markets. The Fed pause, or the pause on normalization and potential scope for dovish policy, is exciting for us and should result in outperformance of these African markets, which have lagged EM and world markets. we continue to just focus on the bottom-up stories, looking for corporate champions that are trading at an attractive valuation and have strong long-term growth prospects. So this brings me to the end of this presentation. We wanted to make sure that we have ample time for Q&A. The two things that I would like to touch on, which I have received a couple of emails on, are Jameer and Bashir in terms of politics. I think we found the Jameer opportunity very exciting, not just from an Africa coverage point of view, but from an interest point of view. They're calling it Africa's unicorn or Africa's zebracorn, depending on how cheesy you want to get with the line. But what's exciting there is that the business is building infrastructure that wasn't there before and is raising capital from very strong and robust investors based on a narrative. It's a loss-making business, and the justification is that they're building a platform to tap into consumer activity on the continent. Now, because investors are funding this long-term consumer play, it shows that there's value in the story if you're willing to look past the short-term time horizon. In the long term, we believe that there's a positive correlation between customer experience and shareholder returns, and companies that understand customer acquisition, customer engagement, and retention will ultimately do well. Whilst a direct investment in Jameer isn't exactly our cup of tea at this point in time because of our quality assets criteria, it is something that we viewed positively in terms of news coverage and data collection, because a lot of the data that we are trying to get in our consumer stories are the same data points that this company is looking at, and it reinforces several themes that we see in our portfolio. In terms of politics, the thing that we always mention is this end of the big man era, this youthful population that is connected and aspirational and urbanized, not voting along communal lines because of rural to urban migration and trying to vote for jobs and opportunity. They suffer from generational amnesia. They didn't grow up during the colonial period, and they're very vocal when it comes to accountability of leadership. Now, the methods in which Bashir was removed and some of these other big men were removed is less than perfect. But at the end of the day, it shows that there's this vocal, youthful population that is actually leading to change. And we view that positively. The politics of the stomach is something we really believe will continue to dominate. Now, thank you for your time. I think I'll open up for Q&A. Harry, if we can open up for Q&A, and then we'll pass the questions around myself, Raina, and Tony.
Please remember to unmute your phones if you want to ask a question, because they've all been muted.
Hi, Craig and team. Thanks so much for this call. Appreciate it. It's Gary from All Seasons Capital. I'm sure you were expecting me maybe to ask a question on Zim, but I want to maybe just touch a bit on Egypt. You guys said you'd spoken to a couple of corporates there, and I maybe want to get a sense of whether they've mentioned anything with regards to the currency. Since the devaluation, it's kind of been stable at about 17, 18. What are your views there? Is it sort of being managed, or are they managing in and outflows properly that they can keep it there? Maybe just get your views on where it's going to go from there.
Hi, Gary. Raina here. I think that the thing with the Egyptian currency, firstly, they had a bit of a backlog after the devaluation. So there was a period of about 12 months to 18 months from late 2016 to mid 2018, where they were simply managing the backlog and trying to clear that. About I would say 9 months ago, they actually confirmed that they cleared the backlog. And that most most of the flows were all on a current basis. The view that we got from the corporates in Egypt is that the market is very liquid. There's no build up in any big liabilities, and because of that, I think you've seen the effect in the currency market, where last year most of the FX was stable at about 17.5, 17.6. Now it's trading at about 17.3, and as with the Fitch upgrade, I think part of the reason the Fitch upgrade came through was because of clearing that backlog in the FX market. I think you could possibly see a slight strengthening in the currency as that news filters through, and more bond investors are actually taking up the carry trade.
Thanks, Ryan. I appreciate that. Thanks for clearing that up.
Pleasure.
Any other questions? The team? You can also always call us afterwards if you've got questions you want to ask us directly. I think there are no further questions. Thank you all very much for joining our Q1 investor call. We're hosting the next one for Q2, but I'm sure we'll be in touch with you all in between.